Today, we are seeing a major pullback in Bitcoin, and overall crypto market is taking a hit since April low. The question is, are they signaling the end of a credit cycle, and are we going into a bear cycle along with the equities market? Bitcoin has been range bound for 3 to 4 months, currently down 23% from all-time high, but still up year to date. This is exactly what institutional adoption looks like: more mean reversion, less explosive upside, more choppy zones. The current market pullback stems from three mechanical forces: the US Treasury draining its cash balance due to government closure, squeezing system-wide liquidity; the rapid unwind of yen carry trades as Japan tightens policy and the yen strengthens, triggering forced selling of US assets. We are again seeing an engineered tightening before the pivot. The Fed is letting its balance sheet shrink while holding rates steady. This is the last leg of intentional tightening before QT ends and rate cuts begin, likely slow and gradual in 2026. The market is front-running that shift, but FX flows, especially out of Japan, are amplifying the pain right now. So why are Bitcoin and crypto underperforming this year? The key driver is real interest rates. Inflation expectations have dropped, meaning money is less inflated. Rate cut expectations have also declined, meaning liquidity is slower to return. As a result, real interest rates have risen, which puts pressure on BTC and risk assets. This is a temporary contraction, not a regime break. When Bitcoin begins to outperform the S&P and BTC ES ratio turns up, that's when we deploy size. Let's look at Ethereum as it's facing a classic market tug of war. Traders have piled into the most extreme short position since 2022, betting on a repeat of the 60% crash triggered by 2025's tariff shock, while long-term holders have sold aggressively, dropping their share of supply below 40%. A mirror of pre-crash behaviors. Yet, countering this bearish setup, institutional big players have amassed a record 22 million tokens, with 4 million added in just the last 2 months, largely driven by Ethereum treasury companies like Bitmine, which now hold 3.5% of total supply despite reducing overall debt from 225 millions to 190 millions. With the Fed starting an easing cycle soon, cheap capital environment empowers treasury firms to leverage up and absorb selling pressure, giving them the upper hand for now, even as leverage risks loom when the tightening cycle eventually returns. My view is that the range expansion we have seen in ES, driven by the carry trade, will be short-term. However, additional risks from leverage or unknown macro variables could emerge later. This is why I'm watching for a clear rally back to the 6,800 level within the next 24 or 36 hours. If we don't show resilience, I'll begin reducing risk and taking a less aggressive stance in equities until the positioning unwind ends. If we were seeing an extreme regime switch in the macro scenario, Bitcoin and crypto were front-running the start of a bear market, but that's highly unlikely.